I think when a company has momentum, the pressure increases to keep that momentum going. It's a catch-22 almost as an investor and a worker, right? Like
You're multiple stakeholders. We're all multiple stakeholders.
right. And so one stakeholder is like, I care about my job. I want to increase compensation. I want to make more money. And then it's like, oh, profit margins are the be all end all for company management.
Stephanie, it's great to have you with us.
Thank you for having me. I'm so excited to be here.
We're going to spend time talking about trends that we both think will be sustained in, not just the next few months, but for the next 12 to, let's say, even 24 months. I want to start, though, with your role. You have a new role as of January. You are the president of Robinhood Asset Management. I want to start there because I want to understand how this role reflects how Robinhood has grown and how it remains maybe core to the mission of Robinhood.
We formed another entity under the parent, and it was with the purposes of being a fiduciary and managing money for people the way it has been done for, a long time, but obviously not exactly the same way because we always want to bring something differentiated and better. So I, by way of background, spent over 20 years at JP Morgan, half of that in asset management, which means my clients are institutions, and then half of that in the private bank, which meant that my clients were high net worth and ultra high net worth people and families. And when I first arrived at the private bank at JP Morgan, there was one thing that struck me, which was that once you have money, you get opportunities provided to you to invest and make more over time, way more than the average person. I got to the point where I felt like we could be doing this for a lot more people in ways that perhaps technology could provide that hasn't been done before. And so we created Robinhood Asset Management as the legal entity for Robinhood Strategies. And Robinhood Strategies was sort of taking everything I've learned with working with high net worth families and saying, how can we bring this to more people in terms of tailoring portfolios, providing the same services, making it feel like someone has really at the core your back, the same way a human advisor might for a wealthy family. That's really, really what drove it.
Well, you and I both have traditional finance backgrounds. I worked at Merrill Lynch in investment wealth management, and I'm glad you brought up your own background because one of my next questions to ground our conversation is, in your observation from the traditional side of Wall Street and managing high net worth clients to what you're seeing now with the explosion of retail trading, what have been some of the major differences in investing maybe over the past 2 decades, and what has really remained the same?
It's a good question. I think about this often. I think technology has really created a shift, an increase in access. Robinhood obviously increased access to investing, started more than 10 years ago. But I think there's sort of like two facets to it. One is that because there are more people in the markets, that there's been this shift away from only the professionals know better.
Mm-hmm.
And I think social media has something to do with that too. Now, I think following various people on X, for example, and threads in Reddit, for example, you can get a lot of information. That can be the place that you learn and grow and put your ideas out there and get feedback on, the same way the professionals used to do when you sat on a trading desk and you ended up talking about, what do you think of this? What did interest rates do? What did this stock do? What were earnings like? Like those kinds of things, I think, can now happen in a big forum where it used to just be accessible to the people who worked in financial services. And so I think that has made a difference where you don't just have to be a professional portfolio manager or research analyst to really, I think, understand companies well. But I'd say what hasn't changed is that some things like fundamentals over time, I think still do really matter.
The fundamentals of the companies.
Yeah, fundamentals of a company, fundamentals of investing, fundamentals of personal finance. I think all of that stuff still really matters. And what I think can be something that people will necessarily learn over time that I think maybe professionals just know a little earlier is that when you're investing for the short term, maybe the fundamentals don't matter and you just really have to think about technicals and near-term events. But you do see a shift as even our customer base ages and
Mm-hmm.
takes on more responsibility, right? Now that they're not just managing money for themselves, they have a family. Also, their focus shifts and they don't think about trading all the time in their own portfolio, but say, I don't necessarily have time for everything. And I know that like investing longer term is also a beneficial thing. So I think like that aspect hasn't really changed. It's just that, you don't necessarily need to hire a professional if you don't want to anymore.
I also think that something that maybe has stayed the same is the underlying characteristic of the retail or the day trader investing for himself and his family, and an institutional trader who has fiduciary responsibilities for millions of clients. And so I feel like the tactics maybe are a little bit different. Am I wrong in that, or has there also been maybe an emergence toward similar pathways of thinking if you are an institutional investor and you are a retail trader?
Yeah, I think what I've seen actually over the last few years in studying, like we have something called the Robinhood Investor
Mm-hmm.
Index, and we sort of study the positioning of our customer base. And what I see most often from that is somewhat similar to the way an institutional portfolio manager might manage their portfolio, is that they make core investments and then as volatility comes, they sort of trade around it, right? If the price goes up a lot, they use it as a source of funds, but maybe not sell the whole position, just, take some profits, reinvest them in places that maybe have underperformed. And I can give you examples of all this, but they are trading around their core positions. And that is, I'd say, similar to the way, a large cap portfolio manager might do. And that I think that may have been a shift. That's not necessarily the case when it's like a smaller position in their portfolio. That's a little more opportunistic, but I would also say that that's what portfolio, institutional traders do.
I find that to be fascinating because a lot of times, and you joined Robinhood sort of in the middle of the frenzy of meme stocks. And, there was a real divide in the perception that some retail traders had of Wall Street guys looking down on them. I mean, I sat in many a clubhouse rooms for many hours listening to them
I still
talk
feel it
about
sometimes.
this. Yeah. Oh, so you do. So you feel
I
like there's
do a little
still
bit.
gatekeeping and sort of some condescension.
I still feel a little bit of condescension. I think it depends on the room and the people. But if you're at like a large conference, perhaps that's like well known, still feel that there's like, yeah, still something that's sort of it's shifted a little bit in that it's not like an assumption that like it doesn't matter that the
Mm-hmm.
retail investor and doesn't matter, but that there's still like a little brother rather
Hmm.
than, they're still at the kids table. And that's where I think that maybe is starting to shift just yesterday. So we're
Mm.
preparing for our second annual client conference. And we were talking to some of the people who were doing a panel discussion with, and they said themselves, like one of them said, I may look like a dinosaur, but I know that I've had to expand my resources in terms of where I look for ideas and where I find out what is trending and what's not. And it's not necessarily the places I looked at 10 years ago.
Mm.
And so I think it's starting to shift, but it's still there a little bit.
Well, I think one of the challenges, if you are really heavily invested in this as your day-to-day source of income, if you're trading, is that there are so many more sources now, especially with content creation. And one big macro theme that I've been looking at and thinking about is the impact of content creation on the economy. And I feel like content creation through people who have YouTube channels dedicated to looking at earnings as they are released, or if influencers on TikTok and Instagram, you have so much more data, but I wonder how much of that is actually good quality. I don't know if you've done any research into the quality, because I probably am somebody who still will weigh a research report from an institution a little bit more heavily than a YouTuber who's going on a quick live stream. Is that really still where the difference lies? Is the access to quality, different tiers of quality of information, or depth of data and analysis?
Yeah, I would say on the institutional side, it's obviously very deep, right?
Sure.
And it's regulated. And certainly in social media, it varies because you will still, if you've been in the markets for a long time and investing for a long time, like we both may have, then I would say that there is there is a wider range of quality on social media. And also it depends on like the length of the content. I think sometimes if you have this short thing, there, they're motivated to get eyeballs and just tell you like the TLDR, but there's so many more details when it comes to personal finance, investing, that it really, the details really often matter and are the difference between deciding to make an investment or not, and picking up on like the shifting trends of an investment. And that's where I think that's where if you only have 30 seconds to tell the story, then I think you can miss some of the important things that can really help you understand better. But there are also other influencers, and I'm thinking one in particular that actually comes to our earnings call,
Okay.
and has a place.
Do you want to name them?
Amit is investing, for example. They actually come to our earnings calls and are placed alongside the research analysts, like the big bank research analysts. And I would say they have been really good at deep diving into companies. And look, they have their favorite companies, and so you always have to remember that. I think no matter who you're talking to, whether it's an institutional research analyst or portfolio manager, like, are they talking their book? That's always a question you have to ask yourself. It's important to stay skeptical as an investor. But I do think he's really good at like deep diving and understanding and putting some and more of those details in like an X post, for example.
Well, you bring up a great point that it segues into the next kind of topic. For us, there's always been this notion that the stock market is not the economy. But if there are more individual households or retail traders making up a greater share of the equities market, let's just say, at what point might the stock market be more like the economy? Or will it always fundamentally be a different system?
I still think it's different, because when you say the stock market as a whole, a lot of people think of the NASDAQ or the S&P 500. And that is really because they're market cap weighted indices. It's like the bigger companies drive really the direction of the markets. And, to stay in, if you want to, we've shown, right, like companies care about their profits and they want to grow them over time. And that will be meaning cutting costs as much as possible and getting more revenue. And that doesn't necessarily always bode well for, as we've seen over the last several decades, the everyday worker.
Mm-hmm.
And where people work often is different than where the stock market is biased towards. Not everybody works in tech, but the stock market is heavy tech, even the S&P 500, maybe not the Dow. But I think that's why there's a difference. And I think I mean, it's never been I shouldn't say a better time right now, but it's never been more important to get invested. And that's like been the drum I've been beating, because when you take a long-term step back, like the worker is not necessarily favored in that big equation. So if you can take savings and invest them, that's how your hard-earned savings can be favored, in my opinion.
Well, on that note, I mean, there has been a trend of people, dating to the meme stock era, publishing their account statements, their trading confirmations to show their net worth, or at least what they are making. And, I'm sure you got served this on your feeds. I've gotten served this on my feeds. People who say, I quit my day job to just be a day trader. Is that really something that you see as a potential catalyst for people who are looking at the economy and saying, like, maybe my job isn't safe and I should really fully invest into this? Or do you think it's still an occupation or an activity that should be limited to folks with certain interests and capabilities?
I still think it's a time-consuming thing. So you definitely would have to put most of your time into it, if that's what you want to make like your profession, and you need enough capital. I think there's a lot of people in this country who don't have the funds to do that. It's something that you could dedicate to, as long as you feel like you can manage it, like manage the risks along with the rewards. But I unfortunately feel like there's still a lot more people who need to work and save. And that's why part of me like loves our platform, that you only need $1 to get invested in a stock through fractional shares. So, it's better to start somewhere than not to start at all.
If you really were to try to set some bounds for people to think about doing this full time, what is the minimum amount of money that you need to start investing to become a professional or to be a day trader as your profession?
Really depends on what your needs are.
Yeah.
But I would say you don't want to do it until you have at least enough to have your kind of sleep at night, emergency, doesn't move kind of money. People have varying degrees of what that is. But for me, I often have said like anywhere from 6 to 12 months worth of expenses that can get you through, I think, like a tough time, right? Like you want to have something that's like, if it's not going well, or if I'm nervous to invest because we're in a bear market or about to be, or we're heading toward that, there are obviously options positions and plays like that that you can make, but I think it's important to have that on the side. And so whatever that number is for you, and then you want to have an amount that you start adding to over time, I think. And to me, I think of it as like a triangle. You have that foundation of, your sleep at night money. I do think it's important to have some diversified investments as well. That number, again, depends on you. And then once you have enough there, at least something that's just kind of long term, you're not going to touch it and you can add to it over time. Then I think you want to have this like bucket of opportunistic active trading positions. The other thing I know is that like if you are only always ever invested in a very diversified manner, I think over time, obviously it shows that you can make money, but if you really want to make a bump in your wealth, you do have to take some risk. I mean, some of the wealthiest people out there like concentrated their risk to get that reward. And so that's why I say like you don't be afraid of that, just right position size it.
And that goes back to having, like in the beginning of our conversation, having the core portfolio and then being a little bit more active around the edges. We're chatting today near the end of August, a few weeks after President Trump signed an executive order allowing alternative investments to be broadened into 401ks, including crypto and private equity. I want this conversation to be something that people can refer to in even 2 years' time. What does this signify to you about the maybe overall risk appetite of the American maybe government or of investors largely? And what will this do to markets overall, do you think?
I think one, it signifies that in the past, with the intention of wanting to protect investors, they were kept from opportunities. And you have seen over the last decades, because of regulations and with right intentions, but maybe not always right outcomes, there are less and less public companies now. I know Jamie Dimon talks about this, like thousands less. That means less opportunity. Companies are staying private more. Why? Because it's hard to be a public company. There's so many more things you have to do, and maybe some of them are right, but I think it's about time that we are stopping making the assumption. And I think this kind of comes back to having this like condescending view, is that everyday people can't handle this. This should only be for the professionals. And I think there are better ways to come at this. Like I think, that's why I think that this is a good thing from the perspective of now you can get access to this. It should be done in a way that protects investors still. You don't want to have them put like all of their retirement savings in one venture capital investment.
Right.
But a lot of my wealthy customers would love to put a, more aggressive private equity fund in their IRAs. Like that was the asset location aspect of investing. And so if you do have this 30-year time horizon, like why shouldn't you have access to that? And just keeping it from them. Like I remember being in forums even a couple of years ago where people from traditional financial institutions said, well, if we open it up to more people, won't the returns come down? And maybe, but also like that's hoarding, hoarding returns. And I still think there's opportunity left aside, even just from the like liquidity premium that you can gain from investing. So I think to me, it just means that like we're actually giving everyday investors a fair shot at having really good returns and opportunities that they didn't have before. Doesn't mean that we need to still be careful about what they have access to.
So with these all combined, these trends of the retail investor having more access to information, having more access to trading through apps like Robinhood, potentially this broader pathway for greater assortment of alternative assets into retirement plans. What do you see being the implications of all of these to the overall U.S. economy? Do you think it will make an impact in any, industry, maybe just in the financial sector, or do you see it spilling over in other ways that we don't see today?
I just wonder if everything becomes tradable. And if that is the case, then what's the value of anything? Like I do sort of wonder, um, like I said, to answer my last question, like we still have to be careful. I do worry that that means like you take advantage and just be like, let's give them the crap and we'll keep the best investments for ourselves.
So what do you mean? So are you talking about like access to a venture fund, or
Yeah,
break
like
down some examples
just
of those fears?
meaning that like being on the side of working with ultra high net worth individuals, sometimes they get approached, one off, oh, make this investment with me, or what do you think of this? And those things never come to light. They're just these sort of private transactions that happen. And if there's something that somebody wants to sell because they don't think there's any much opportunity left, is that what will end up going into some 401k type of fund? That's my worry. And so that's where I think like, oh, when someone asks, won't the returns go down? I don't think it's that. I just worry that there'll be an easier path to give the not so good opportunities. Maybe a company that needs funding, we'll sell it to retail, because that's used to be perception, right? Retail was always the last in and the and the last out of things. I don't think that's the case anymore at all, because in public markets there's way more information available now. But on the private side there's not. And that's what I worry about. But does it also mean, like, especially with tokenization, like, can there be a marketplace for everything? And then it does allow price discovery. And the things that you value that you would have never maybe thought of in a light of a market, like maybe that becomes tradable. And we've seen this with prediction markets. Like,
Yes.
we just dropped like football. You can bet on the Emmys, the hot dog eating contest on 4th of July. That's where I think it's like, it gets really interesting because it stops being just about what the professionals know, but like actually now everyday investors can put their personal knowledge to use in the marketplace.
I mean, it almost sounds like what you're saying is a couple of things. One, gatekeeping will exist. It will find a way.
I think
If
so.
if supply ends up flooding the market, the premium holders of the supply will still find premium buyers, and that will be, again, its own isolated tier of inventory and of opportunities. And then down the line, as all the markets broaden, and like to your point, like betting markets especially, it almost feels like for someone to really do well in the economy on a relatively greater scale than their peers and on the bell curve, it's going to be a total like risk game, where if you can stomach the risk and you can stomach the downside, the upside could still be enormous, and we might see that creeping into things. Is that sort of a good summary of what you're thinking about, just in terms of even like the betting markets, and especially with sports now betting being so huge?
I think you're right on the gatekeeping. Just to put a finer point on what you said about I think there's an expanding category of markets. And I think I'm not sure it's so much like increased risk, but that you can apply, like, markets will expand to the point where you can apply your personal knowledge base to the markets. And there can be a market for your personal knowledge base. So if you know a lot about pop culture, like maybe you can put that to work and actually put some money behind it, versus having to know about the details of a balance sheet and cash flow analysis and what earnings expectations are for a company. Like perhaps you can have a focused investing strategy that is placed to your personal strengths.
But that's fascinating, because then you are moving away from the fundamentals of that, the basis of investing, and more to the narrative side.
But the fundamentals, like, that maybe, right? I'll just use the hot dog eating contest.
Yeah.
Like, I was thinking like the winner, and now his name is escaping me, Joey. And He was out last year because something about the sponsorship, but the guy that had won ate way less hot dogs than him, and he was finally back. And I thought, well, who else could win? Like in my mind,
Right.
but knowing that backstory, like not everyone knows about the hot dog eating contest on Coney Island on 4th of July. But if you know a lot about the different potential winners, maybe you work in Hollywood as a costume designer, and you can put that sort of personal knowledge and your own quote unquote fundamental research to work. Maybe you can invest in who you think is going to win best actress this year. And, or if you're in, about movie ticket sales. I don't know what the
Yeah.
right, yeah, but
Yeah.
maybe it's just a different kind of fundamental research.
Got it. I mean, you're also, I think, giving people who may be intimidated by investing in finance that like their expertise in their industry can be investable, can become investable sort of ideas, in our sort of speak. You saw that a little bit with the AMC meme stock trade. I would talk to retail traders and they said, look, based on my own personal movie watching experience, like there's one across the street, I'm going to go, I feel good about it, so I'm going to invest. Like that, it seems very analogous.
Yeah. And I personally think everybody has, and Peter Lynch used to say this all the time too, everybody has the skills already within them to be a good investor. He said, if you pass 5th grade math, you can do it. And I do think like I always say about investing is like expectations are everything.
Mm-hmm.
What are expectations relative to where you think reality is? And everybody has an interesting seat and perspective that even the professionals might not have, right? Like if you work in finance in New York, you're in a finance New York bubble, like in many
Very
ways,
true.
right? And it's the same thing in tech. If you're working Silicon Valley, you are in that kind of a bubble. If you're not in those bubbles, sometimes you have a different perspective for a certain company, what you think their business is. Target has not been doing well, for example. They had not great earnings. They changed their CEO, but it was a CEO who had started as an intern there. So it was,
There for like over 10 years. Yeah.
I know, which that's the meme about like no one will understand his track because he's never moved. But the point is that there's a, there's something you could see from going to Target and shopping there and starting to see a shift. If everyone's doubting this new CEO is really going to create new change, you can have a perspective as an everyday person that doesn't necessarily mean you can't pick up on a shift.
I like that a lot. I want to end our conversation with some trends that you're watching that you think will persist for years to come. Earlier this year, you were on CNBC talking about how the retail cohort, they weren't buying the dip as much as maybe in the past. What other trends are you seeing in the pattern, the persona of a retail trader that you think will be the case for the next, couple of years? Or is it too hard to decide or too hard to determine what those are?
I I think a couple things maybe. When I was on CNBC that time, I think that was like the February. We had a little bit of a
Mm-hmm.
dip in February,
Yes.
and I was
Yep.
like, things feel different. And obviously, we had a deeper dip in Liberation Day. After that, they bought the dip hard,
Okay.
and used broad-based index funds for that initially. I think the trimming and adding trend will continue from a trading perspective. I think the expansion of knowledge and understanding, being able to analyze a company, especially with AI, I think will just continue to happen. Some people think like, oh, the active trader is like the way to be. But if you're a young person and you're interested in markets, you may be an active trader, but over time, that natural life path of getting older and having expanding responsibilities and maybe wanting to buy a home, potentially having children, depending on whatever you choose, that didn't change. And
Mm-hmm.
so I do think like, and the needs expand and wanting to be able to have a will in place and take care of your family, like, or the people that you care about, none of that changes. And I think being able to do that with technology, with AI it will be even more accessible. Like, being able to just create your own will and have a lawyer, for example, just like rubber stamp it. Like, I think those things are coming, and I think it will create greater financial stability, feeling like you have control of your own destiny. Like, I think that will come with it. And, obviously, hopefully having more access will come with that too, in terms of investment types of investing. But I do think it doesn't mean that we won't have some sort of like pullback or something that happens with this. Like one area that I do get nervous about is just like borrowing.
Mm,
And if you look back in history, every time something went wrong, it was really just like too much debt.
yeah.
And so that's one thing I worry about, especially with, the debate around inflation and like things just continuing to cost more and people wanting to maintain these lifestyles that like sometimes, social media perpetuates this desire. Um, that I think, that's something I feel like we could have, I don't know when, I have no idea when, but I do think we could see an episode like that again because it seems like eventually it becomes human nature.
Well, the voracious appetite for the Mag 7 stocks, which are, I think, regularly on your most traded stocks list month after month. This kind of goes full circle to why I wanted you on the show and talk about the impact of retail investing on the economy is the biggest companies just keep getting bigger as more people pile in their money. Then they get talked about the most in the media. I mean, it's this cycle. If you were to guess at what happens, and even using your past experience, as a company grows in market cap and grows in importance to an economy, whether it's from institutional investings or just from their own business, and now more retailers getting in, what happens inside of those companies? Do you think they feel like more responsible because they have more shareholders? Do you think that they are operating any differently?
I think when a company has momentum, the pressure increases to keep that momentum going. And so I think there's, what else can we build? What can be the next big thing? How do we how do we leverage new technologies to grow even faster in the future? And it doesn't mean it's impossible. And actually, there's a lot of examples of like this not really stopping yet. But I think of like Apple, for example, right? Which did feel like it reached this plateau or still is that's its plateau where it's almost a consumer staple. Like everyone's got an iPhone and we'll continue to use them. And my, AirPods, but it's not necessarily a company that feels like it's growing as fast a clip as it was, and just taking market share. And I always think back to this book that I read a long time ago that is meant to be a business book, but it's short and quick, and it's a kind of a ridiculous premise, which is mice. Um, it's called Who Moved My Cheese?
Okay.
It's about mice that are looking for cheese in these like tunnels, and they find a ton of cheese in this like one area, and they all sit there and continue to eat and love the growth that they're having. But then a few of them look around and they say, like they look at all the cheese and they say, is there enough cheese left for us to continue to stay here? Or do we need to go like find new things?
Mm-hmm.
And some of them leave, and then other ones, some of them are too large to move now because they've eaten so much cheese.
Yep.
And so I think that's what happened. I think about this all the time when I think about companies and
Okay.
analyzing them. And so I think, did Apple think like we're good? We don't need to keep innovating. We'll just continue to grow with the population. But in the initial stages of this growth of momentum, a company feels that pressure as like senior management has to continue to just remind people like be grateful for what you have today or what we have grown today, but know that it can go away. Yeah.
Well, but that also goes to, a point that we were both making that you were making earlier around companies staying private and or not, fewer
Yeah.
public companies. I mean, the pressures are growing. You've got more investors now, more eyeballs, more attention. The other, reason I wanted to bring this up is because oftentimes you have people who look at a headline. If a headline says, XYZ company is making lots of cuts, or reducing or headcount or increasing prices. It's all about margins. People get upset, but sometimes I want to take a step back with them and say, are you an investor in this company? I mean, you kind of need them also to do the things that they're doing to grow the profits. And so we're all sort of tied to each other is kind of my point. I want to have you help me make the connection between the overall economy and just how much more interconnected everything is.
I think, yeah, you're absolutely right. Like it's a catch-22 almost as an investor and also a worker, right? Like
You're multiple stakeholders. We're all multiple stakeholders.
right. And so one stakeholder is like, I care about my job. I want to increase compensation. I want to make more money. Look how hard I'm working. And then it's like, oh, profit margins are the be all end all for company management. That being said, there is a connection between the two in that if you never show that you can grow your compensation and input, people won't necessarily stay around, right? At some point, company management will understand that they need to make their employees happy so that they can grow, right? So it's not completely at odds. But yes, if a company isn't doing well, they have to make those hard decisions. And, Robinhood, we did do layoffs a couple of years ago. When it happens, it's usually necessary and it stinks for the people who are impacted by it. But if a company is doing well, you have to make sure you take care of that connection between people who are working really hard for you and you keep, you kind of like keep them happy. And that's where I think sometimes a company will make that mistake. You've seen it over time where it means that employees become like they're just numbers. And that's not the case. AI could shift that. Right? Because I think there's definitely moments now where my old brain, my first thought is I wish I had an analyst to give this to and read this and summarize for me. And then I'm like, no, I already do. And I put, right? Like I put a bunch of things in there and I have them read and summarize it for me. And that is like, that's where I think we are today. But what happens in the future where they can do even more? And that's a way for companies to cut costs that isn't necessarily related to a company doing poorly, but just, and so that's where I think like, for young people and even just like, you got to stay on the technology. You got to show that you're like, you want to work with it. Cause I think sometimes there'll be a natural human instinct to block that stuff and try to show how much you're personally worth. But I think what you want to do is be like, okay, this is how we can use AI. Because also some of the people I've worked with in the past do even better when they try to build their team such that anybody on their team could replace them, right? Like if you think like, if I work with AI in a place where it could almost replace me, I might actually be making a more secure job for myself.
Yeah, I guess that is one way to think about. It's tricky. I mean, like I think the agreed upon idea now for job security in this age is that your job is not going to be taken by AI, but by somebody who knows how to use AI. AI is a whole separate topic, which is why I didn't ask you about it at all, which is always fine with me.
I can come back.
Yeah, let's do a whole separate one. I really appreciate your time. I think that hardest question at the end really was trying to just make that connection that we sometimes, if we see it as a headline and then we have one set of feelings or we see the reality on one end, but there's also this other outcome is really important to this whole cycle.
And that's why it's good to stay invested.
Right, and it's a good way. I think I have always loved business news because I think it's the best way for anyone to understand like where the future is going. But for today, we'll leave it there, Stephanie. It was such a pleasure to go through these ideas and themes with you, and I hope to have you back on again real soon.
Thank you so much.
All right, take care. Bye.
Take care.